moderator for this session is Cara Shelby from our PwC Canada office. Cara, over to you.
Hello, and welcome to the webcast today. My name is Cara Selby, and I'm an international tax partner based in Canada. The theme of the webcast will be an update on the current state of Pillar 2, and then we will dive into the practical implications of Pillar 2 to the corporate tax functions with a focus on modeling, data challenges, future compliance, and operational and technology support. As a brief summary, the Pillar 2 models were released in December of last year. The commentary was released in March. There was a public consultation on Pillar 2 in April. In addition to the work of the OECD, the European Commission published its draft for a directive on Pillar 2. Therefore, there is quite a bit to talk about when it comes to Pillar 2. Today, we have brought together a panel of subject matter experts, and I would like to introduce you to our panel today. We have Jessie Kavanagh, who is a tax reporting and strategy leader with PwC Hong Kong, Jorgen Brothers, who is also a tax reporting and strategy partner with PwC Belgium, Taylek Tan, who is an ITS and tax accounting leader in PwC Singapore, and Will Morris, Deputy Global and Tax Policy Leader with PwC US and Chair Emeritus of BIAC. Will, could you discuss the current state of the model rules, the commentary to the model rules, the path to adopt Pillar 2, and as a representative for PwC and BIAC, can you provide us with any updates on the public consultation in April and the most recent ECOFIN meeting in May?
Sure, thanks very much, Cara. So the good thing is we have at least an hour and a half, maybe 2 hours, 3 hours to discuss what's going on, because there is an awful lot which is going on. That said, I'll try and give you the overview in a few minutes. So as you said, the model rules came out in December. We've had the commentary. The phase that we're now moving into, and which is obviously of incredible importance to businesses, is the crafting of implementation guidance. The model rules themselves give some hints, but they are not totally ambiguous, and in some respects they're actually quite high level. The commentary expands upon some things which are in the model rules, but again leaves a lot of questions open. And then, just as importantly, maybe even more importantly in a sense, as businesses begin to dig into these rules and to think about the interaction with, the real world, with actually how businesses work, how they do business across borders, what this means for them, then in fact more questions emerge about the operation of the model rules and how these are going to work. So there's a lot of work which is going on at the moment. It is now expected that this will go at least through the end of this year. The earliest conceivable point at which there will be a sort of critical mass of implementation. You can never rule out one country jumping ahead of the others, but that there will really be a critical mass of implementation is the beginning of 2024 for the income inclusion rule, and the beginning of 2025 for the disabled. We may get into those a little later when Jessie and Jorgen and Taylek are talking about this. But with the EU directive, still not passed, still not adopted, needs unanimity in the EU, still not adopted. Perhaps it won't be adopted in June. So towards the second half, maybe in the second half of the year. The French already pushed back the deadline, so that's why I say the beginning of 2024, despite what the OECD originally said. And it's thought that other countries will also follow suit. There are other countries like the UK, like Canada, like South Korea, like Japan, Australia, etc., who are talking about legislation or consulting about it, but I don't think we'll move forward out of step with what the EU does. So that seems to be, the likely date for that. But all of that said, there are a significant number of issues which arose the moment people cracked open the model rules, but have emerged. More have emerged since then. And to go back to that public consultation in April, there was a lot of talk about what might be done. I did have the privilege of opening up the conversation. And I mentioned a number of points. The first is that it would be helpful in some cases if the rules themselves could be reopened. There are some critical problems with the rules which have emerged over the past few months, particularly around how non-refundable credits are going to interact with the Pillar 2 tax base. That's a particular problem in the US, but not just in the US. Also in Europe with certain types of R&D credits, for example, renewables credits. There are other issues around booking down to the min tax rate and other things that will probably be talked about later, and indeed which we've talked about in the past. The first thing that I mentioned, and other people emphasize this as well, is there is a critical need for safe harbors. These rules are so complex, and yet in the end, having been through that complexity, many people will find that they were never intended to apply to them or to many of the countries in which they do business. So safe harbors are critical. There should be consistent implementation wherever possible. We face the risk that 137 countries enact this in slightly different ways. And that will further add to the complexity, the difficulty, the nightmare, honestly, of trying to comply with these rules and administer them. The transition rules are already creating some problems when it comes to, for example, step-ups in basis. The sort of the deferred tax accounting aspect of this, which is modified deferred tax accounting to be very sure, and again, I know the others are going to talk about this, creates problems that we need to try and drive for simplicity wherever we can do. One of the things which has emerged is that the model rules are largely built on an assumption of IFRS, and therefore if you operate under another GAAP, particularly US GAAP, but other GAPs as well, then some strange results are going to occur. And we need to be able to deal with that. And some way for coordinating between countries to try to get consistent in implementation, or at the very least, consistent forms, consistent ways of filing, tax authorities talking to each other would be great. So, I think we're in the middle of this process. I think there's still a lot of opportunity for business to input, but I think that the more we look at it, I've used the onion analogy before. This is an onion with many, many, many layers. And every layer we peel away, we find new questions, new issues to be dealt with. So this is not going to be a simple thing to do, but there is a process for doing that. Obviously, the one thing I haven't mentioned is what goes on in the US, and that the answer to that is because we really don't know what's going to go on in the US in relation to legislation and to GILTI and to what that's going to mean. But that is something for the future. So anyway, with that, Cara, let me hand back to you.
Thanks, Will. There's so many points, but there's a couple items that sort of stand out from your update. First, the deadline has been pushed back. We have till probably 2024 for most countries. Second, the model rules were issued without input from various countries, and there's a clear lack of input from the business community and relevant stakeholders. And then finally, the complexity of the model rules are just further reaching than we initially thought. And, there are definitely some changes that we think that need to be made, especially when you mention the transition rules. And for example, taxpayers usually don't pay corporate tax when they're in a loss position. But then under the model rules, there are instances where there's a top-up tax required to be paid, even if there's a loss at the constituent entity level. This isn't definitely what we expected, but the commentary made it abundantly clear that the OECD contemplated this outcome. So let's start with some of those complexities resulting from the requirements to not only transform the model rules into each country's legislation, but the overwhelming interconnection between financial accounting and tax accounting skills that are needed to interpret these rules. Taylor, could you start us off with a discussion of the complexities and technical difficulties that you've encountered in respect of the tax accounting combined with financial accounting requirements embedded in the model rules?
Thanks, Cara. Good morning, good afternoon, or good evening, ladies and gentlemen, wherever you are. I guess the first thing I want to impress upon you is that it's not all doom and gloom. Despite the complexities, the short timeline to implement, and on top of the challenges of your day job, you can potentially turn this adversity that is Pillar 2 into an opportunity. But more on that later. Okay, there are many areas of impact of the Pillar 2 rules on tax accounting and vice versa, which will take me a while to go through. we're just now starting to work with clients on issues that are peculiar to their situations and understand the practical impacts of these rules. All the adjustments to cover taxes in Article 4, to put it in a nice way, will probably make life interesting for the internal tax or finance team who has responsibility over tax accounting. That is, if you are, the glass is half full kind of person. So let's look at some of the more common difficulties that we see companies having to grapple with. We first start with having to identify all the different components that you have to exclude from adjusted cover taxes. The taxes on excluded income items, your shipping income, etc. So that sounds easy and straightforward, right? Just take out taxes on the on the excluded income. But think deeper. You have to work out the tax expense attributable to those income items, which means you have to know what are the attributable deductions, allowances, and other items that ultimately results in that taxable income. This is something that you may not have done before and do not have details to, especially if you do not have a statutory requirement, right, to identify these different types of income, the direct expenses, and to find a reasonable manner to apportion common expenses. As you will see, the need to go into details is a common theme in GLOBE ETR calculations, especially when it comes to adjustments to cover taxes. The next thing you have to segregate is the components of your deferred tax balances. You need to identify those items that are again excluded from the GLOBE income or loss, your uncertain tax positions, look into your valuation allowances and reverse them, and what are your recapture exception accruals, and the list goes on. So there again, you have to go to a great level of details that needs to be worked out. It will take a bit of work, and some of these rules may require you to trace the components to the historically to when they first arose. Now, there is this rule that caused quite a bit of controversy. A fundamental concept of Pillar 2 is to look at ETR, on a sum of year basis and to neutralize the consequences from differences between accounting recognition and tax rules. So this concept is deferred taxation. So, ETR takes in the deferred tax balances as per the financial accounts, but there is then this requirement to recast, your deferred tax liability at the minimum rate. So since deferred tax is an accounting concept, to smooth out, fluctuations in and to identify the tax expense attributable to the income item that may be recognized in different periods for tax and accounting purposes. So why is there a need to do a recast, right, at the minimum rate? It seems to go against the policy of smoothing the ETR and does not recognize the actual tax burden that the underlying relevant timing difference create on the constituent entity. There could be cases where you have to pay top-up tax, and then that feeds into your tax provisioning and or accounting, and you have to work out revalued numbers and take any top-up tax into account when proposing your tax provision balances to your auditors. There's also a rule that disregards domestic tax rate changes, which may result in additional deferred tax liability or decreased deferred tax assets. It further complicates the calculations, but you just have to do it. Both sets of calculations will have to go into your financial reporting. You have to track to recapture deferred tax liabilities that are not paid within 5 years, except where those exceptions are provided in the model rules. And of course, we have the famous Article 4.1.5, which requires top-up tax liability where it's clear that you're in a loss position. So you have to keep in something that you have to keep in mind when you do your tax provisioning. You do not stop when you see a tax loss for domestic law purposes. You have to calculate the GLOBE position. And finally, if you have different types of entities, such as PE, hybrids, or tax transparent entities, you will see that the rules gets very complicated, and you have to decide if the tax is to be picked up by the PE, the main entity, or the on the constituent entity owner. So it can be a tedious exercise, at least in the initial years.
Thanks, Taylor. But the model rules are not the only challenges. The complexity of the rules aren't the only challenges we face. It's also challenging for legislators, tax authorities, clients, and the tax business community to prepare for the implementation, because the details of Pillar 2 aren't final yet. Although many countries have announced plans to adopt Pillar 2, Canada included, as Will noted earlier, those countries still need to clear the rules through their legislative processes, draft the legislation, design forms and systems. Could you expand on how the challenges you just discussed may affect reporting packages and the need for clients to prepare early?
Sure, Kara. So when you do tax accounting, there is a very helpful principle you will always keep in your mind, right? Materiality. So when you do a tax provision, you need not go down to the most minute details of what is deductible or not deductible. When you have a difference between your P&L method and your balance sheet method for deferred tax calculations, you reconcile to a reasonable number, but almost always never to the last dollar. Your auditors will be happy to work with you on that level of maturity and sign off on your accounts. But I'm not sure tax authorities have the same training as auditors and probably not the same thinking. When it comes to deferred tax balances that relate to excluded, globe income items, unclaimed accruals, and so on, you probably have to get it right, because you may end up paying too much tax, or worse, too little tax, and then you then are in a situation where you may have to pay penalties. So as I mentioned earlier, right, getting into details is going to be something that you need to get used to. If you look at a typical tax reporting package, you have the current tax calculations, deferred tax calculations, RTP calculations, reconciliations, and other items, according to your specific company needs. Now you have to collect new information, details, track deferred tax balances for their expiries, and so on and so forth. There's also a potential impact on the tax provisioning process at the very least, since your RTP needs to be done for the domestic tax return and then for the globe return, and both results will then feed into your tax provision. I think clients can already begin to have a feel as to how big a change will be needed to their tax reporting packages. What kind of new or revised linkages needs to be built to consolidate to your consolidation financial reporting systems. The system design, change, and implementation process will likely take months, if not years. As you know, as Will mentioned just now, right, the talk is for Pillar 2 rules to be adopted in domestic legislation, 2024. But when it comes to tax accounting, bear in mind that your first reporting period is in that financial year, it's the quarterly reporting after the tax law changes comes into effect. So you're looking at a much shorter time frame than your formal tax returns. Should you decide that a system redesign, update, or complete change is needed, do you just do it for Pillar 2? Right? Can you link it to your CBCR? How about linking to entity management systems? I think these are things that client can take the opportunity to have a think, to have a more complete reporting, tax reporting system that will be, for lack of a better word, fit for the future, right? So while there are challenges, Pillar 2 also presents opportunities for you to take your tax reporting to the next level. Yeah, I would say, sticking my neck out, right? This is probably the best chance in the past decade, given the high profile nature of the Pillar 2 rules, for the finance or the tax team to get the technology budget that they need to make the tax reporting more efficient. Just one last thing, has to do with the human aspects of tax accounting work. Whether it's the finance team doing the reporting, or and relying on the tax team for technical knowledge, or the other way around, tax team doing reporting, relying on finance for data. There'll be a need for much greater coordination, training, and regular communications. We need to happen to get everybody just through the transition.
Thank you. Your comments on technology and needing more and more technology are very well heard here. On that note, Jesse, you've been pretty hands-on in respect of the modeling of the impacts of Pillar 2, pre the issuance of the model rules, when we just had the blueprint to use, following the country by country data, and then post issuance of the model rules. I think you've probably maybe been able to model for more than 50 Asian headquartered multinationals. So as you get into the weeds of those calculations, what are we seeing? Is there good news or is there bad news?
Yeah, thanks, Cara. You're exactly right. So we did start off that modeling exercise traditionally using C/C data for clients using the blueprint rules or exposure draft. And then more recently, we've been doing more detailed impact assessments for clients and taking both more granular data from the client, but also using the model rules and commentary. And you're exactly right. We have seen different results. And unfortunately, there is bad news, but there is also good news. And maybe if I start with the good news first, the detailed modeling is generally resulting in a lower top-up tax exposure than was estimated from those high-level C/C assessments that we've done. And there are probably 4 key reasons that we're seeing driving that. The first is that the C/C data for some groups included dividends, and that obviously needs to be excluded for Pillar 2, or most dividends do. Secondly, excluded equity gain. So we had a couple of groups, particularly if they've done a large internal or group restructuring, maybe made a gain from disposal of shares in that restructuring. And again, that needs to be excluded from that C/C data. Similarly, you've got the deferral or elimination of fair value gains and losses, as you can move that onto a realization basis. And then finally, the addition of deferred taxes in helps uplift that ETR and therefore bring down the top-up tax exposure. So that's the good news, that the 4 main reasons why we're seeing a drop in the estimated impact. However, turning to the bad news, and we are definitely seeing some unexpected results. Cara and Taylor, you've both highlighted the first one that is coming up. We are seeing real life modeling of that Article 4.1.5, or where you've got a top-up tax for a jurisdiction with losses. And we've seen real life examples of that come up. And it's it's generally been in high tax jurisdictions, which has added a little bit of additional surprise to the clients. The second point of bad news, or reason why we're seeing some unexpected results, again, this has been highlighted already, but deferred taxes, and specifically the cap at 15% for the deferred taxes. Once you have the interplay with permanent items, then that's giving rise to some top-up tax exposures. The third one, and this can be a big one for certain industries, and it's the reversal of deferred tax liabilities. So with the transition rules, which have been mentioned, and maybe some more work that still needs to be done there, but when your deferred tax liabilities upon transition into the rules start to reverse, that can have a diluting effect to your ETR. And for some of our clients, as they've modeled that out, that has actually been quite significant. And then finally, the last point, we are seeing some unexpected results on the interplay between the globe rules and the financial accounting rules. So we've predominantly been looking at an IFRS-based approach and not going into some of the issues that Will alluded to for US GAAP. But even between IFRS and the globe rules, we are seeing some unexpected results. A simple example of that is in relation to depreciation and fair value accounting for certain tangible property, and you end up with some parts that get excluded where you wouldn't expect that to happen. So that's probably the good and the bad news, Cara.
The results of your modeling are very interesting, and it sounds like you have some unexpected results for both good and bad. Perhaps you could elaborate on the challenges in collecting the relevant data to complete the modeling. Clearly, the modeling requires your clients to gather the financial information on a jurisdictional and entity level basis. I know many client information systems may not collect data in this manner and may not have the information readily available on a separate entity basis. Could you discuss a bit of what you've encountered so far?
Yes, absolutely. And you're exactly right. When we went in and started looking at the detailed modeling with clients, almost every single one of those clients had the data at what I would describe as a bottom-up approach. So it was starting with legal entity results for the legal entity and working out how to make adjustments as necessary, rather than taking the overall group consolidated accounts and allocating down at the jurisdiction level. None of our clients really had the systems in place to be able to do that. I would like to just briefly sidetrack, if I may, and just give some context around the data required. And so for the high-level C/C estimates we were doing, we were asking for 5 to 10 data points, and they were generally or almost always available at the sort of central or headquarters level. Move to the next level where we're doing a detailed impact assessment at the moment. And because it's just an impact assessment, not the actual compliance, we're asking for about 40 or so data points per entity. And again, that's the stage where none of our clients have really got that full data at the central level. But I would also highlight that as we get into compliance in the future, those 40 data points aren't going to be enough. We're estimating it's probably at least 130 data points per entity and potentially a whole new ledger. So just to give that context, now let me please step back and talk about the challenges we had in gathering the 40 data point data, let alone the full compliance data. And there are 3 key things that I'd like to highlight here, or 3 key issues that I think have come up for our clients. And then the first one is around consolidation or topside adjustments. And so I think, as our audience knows, the rules start with financial accounting net income or loss of an entity as determined in preparing the consolidated financial statements. So this means that if you're starting by using the results from local financial statements, you likely require some level of push down of the topside or consolidation adjustments. An example of that might be due to different accounting standards used between local and group level. Identifying when those consolidation or which consolidation adjustments to push down and how to allocate them to a particular entity, that's been really challenging for our clients. One example, one of my clients, the tax director, she asked her finance team for help with this, and she received a spreadsheet with 2,000 line items, and each line item had a 16-character description of what the item was. There was no way the tax team was able to decode that and decipher that. Unfortunately, this issue can be exacerbated by groups that have multiple levels of sub-consolidation in their accounts as well. The second challenge that we're seeing actually comes from something that might seem quite simple, and there are a few of these. So dividends, for example. One of my clients had dividends from short-term and long-term portfolio shareholdings, dividends from associates, and dividends from constituent entities. And as you know, all of these dividends potentially require different treatment under the Globe rules, but the client's existing accounting data wasn't able to differentiate between these dividends. And so just a single account for dividends wasn't helpful in being able to do that. There was a lot of manual work they needed to do to go in and be able to distinguish that. And then finally, deferred taxes. And this one's interesting for me because I expected deferred taxes to be the biggest challenge, but so far deferred taxes hasn't been as big a challenge. But the reason I would say that is the impact assessments we've been doing broadly take a single year snapshot of deferred tax. And so it's generally taking the deferred tax expense, maybe a few adjustments that are in the accounts. It's not looking at a year-on-year change or looking at significant changes through a balance sheet or a recast balance sheet. And so looking forward to the actual compliance in the future, the clients that I've been speaking to, deferred taxes is absolutely one of their areas of most concern, even though we haven't seen that as much at the moment. Many of those clients are anticipating the need to maintain a separate deferred tax balance sheet from year to year for Globe purposes. And that ledger looks different to local book and tax balance sheets. Taylor's mentioned some of the challenges there, but a couple of things that are coming up for us, that the need to trace and potentially recapture those recapture accrual DTLs in that 5-year period. And then you get deemed basis under the Pillar 2 rules in assets and liabilities through transition rules, reorganization rules, realization basis elections, and all sorts of other adjustments, which may not align to either your local book or your local tax books. And so we're seeing a lot of concern for clients for that future data side of things for deferred tax.
Wow, 130 data points. It's clear that ERP systems are really going to be important because businesses will need to be able to gather all that required information on that legal entity basis in order to comply with the rules. You know, there'll be several streams of information, and, you know, it sounds like we're going to be maintaining several sets of books. Jorgen, what should our clients be doing now to prepare for this significant compliance requirement? How can we help them? What kind of tools are we able to help provide them with?
Thanks, Kara. Well, looking at the compliance challenges indeed coming our way, it's crucial to start now to avoid being caught out in terms of timing. Tylek, you already referred to it. Remember that the first calculations of the Pillar 2 impact, they will be required at the start of the first financial year when enacted, so well before the actual Pillar 2 information return obligation. So I would say there are 5 steps that you will need to go through. First, you need to get a really good understanding of the tax technical challenges. This could be the impact of historical transactions, treatment of JV, specific deferred tax positions, interaction with Pillar 1, elections that you need to make, and many more. Will, Tylek, Jesse, you all refer to a lot of these items. And this step, it's important because this initial analysis, it will allow you to identify where a deep technical analysis may be required, where positions are to be taken, but mainly to make sure that you identify where the material discussions will be. And it's crucial to make sure that you focus on those to not get lost in the details. Next is the analysis of the data quality of the consolidation gap. So how good is the data? Is the data available at the right granular level? Are there topside adjustments to be taken into account? So this is the starting point of the calculation. So you need to make sure that you've got a really good understanding of any data challenges at this level. And typically here, you will need to work with the accounting technical specialists or the consolidation team to support you in the analysis. And Jesse referred to it already. There's a lot of this data, which is today certainly not readily available. The third step is to look at the globe calculation, really line by line going through the different data points needed for each step in the calculation. Is that data readily available? What do you need to do to determine the data points? Because this will give you a really good initial understanding on where further work will need to be done in terms of the data collection. And if you recall that the prioritization on material items we had in step 1, it'll help you to make sure that you spend the time on the right elements. So typically this step will require a very strong interaction with the broader finance function in your organization. The fourth step is the same exercise, but this time for the cover taxes. Again, there's a lot of underlying analysis to be done on the availability of the data. Typically also the need to involve your tax accounting specialists to manage the differences in deferred taxes, both Tylek and Jesse already referred to. So this step will need to tie in efficiently with the tax reporting tools and processes in place. And then the fifth and the final step is to put it all together in your target operating model. Define the solution to calculate the Pillar 2 impact, do a pilot to map the data, and do an actual initial impact assessment. There's tools we have, for instance, available who can help you to do that in a very efficient way. Because based upon this, you will get a good perspective on where all the real challenges are. You can define your roadmap for the implementation of the required people, process, and technology to get to an efficient and effective way of working going forward. Now, one key feature I think is crucial in the target operating model is to continuously think in a two-stream approach. One stream focusing on the tax cost, all about assessing, modeling the impact of the Pillar 2 taxes. But over time, you're going to need to make sure that this becomes a standard for every change in your business environment, that this is updated. And the second stream, that focuses on the cost of compliance. It's what are all the operational processes which are required to calculate the Pillar 2 impact and to be able to meet the compliance requirements going forward. And I do agree with Tylek's comment earlier on, and I had indeed a number of clients already confirmed to me that because of these additional requirements, because of the strong interaction there is with the finance function, it is a unique opportunity to make sure that as a tax function, you have a voice at the table when it comes to a next ERP implementation, a next consolidation platform, or any changes on the existing processes. So these would be my recommendations in terms of next steps, Kara.
Thanks, Jürgen. So just before I wrap up, Will, one final thought in 30 seconds or less.
So this is enormously complex. I think, as everybody has said, paying attention to this is really important. You know, Jürgen made this point that yes, the effective date may be 2024, but you need to be prepared before that. And as Jesse said, you're going to have to start reporting, you know, at the end of the first quarter of 24. From my point of view, you know, trying to, with real life examples, take those to your own governments, take them to the OECD, talk to them about what needs to be done, the implementation guidance, because the simpler we can make this, whether it's safe harbors, whether it's sort of taking the rough edges off things, whether it's explaining how some parts of the accounting work, so that the final rules that countries hopefully take into effect in the same way will actually make this a slightly simpler process to comply with and a slightly simpler process for governments to administer.
Thanks, Will. And with that, I want to thank my panel of experts and all of your insights today. And we are going to wrap up this session. Thank you very much to everyone who has joined us today.
Thank you very much, Kara, and the panel for the very, very interesting discussion. A lot to come. I guess that could be the summary for this session. A lot of information, very interesting, but still a lot to come.
I think you said it correctly, Adriana, that there's lots to watch. And on that topic, we'll move to our second presentation for the day, which will focus on M&A. In particular, the session's going to focus on geopolitical trends and the related M&A considerations, including how tax functions can add value during a deal, ESG from a deal's perspective, and coming right back around to that topic of Pillar 1 and Pillar 2 in the context of deals. So I'll now hand over to our moderator, Mark O'Reilly from PwC Australia.
Hi, everyone. My name is Mark O'Reilly. I'm the M&A tax lead partner in the Asia region. Today, I'm joined by a group of panelists, and I'll let them introduce themselves in a minute, where we're going to discuss some topics relevant to M&A at the moment, including geopolitical trends in and the impact on M&A, ESG and transactions, and what that means, and what we're seeing evolving in the market on that. Pillar 1, Pillar 2, the impact on M&A and what we're looking at, and some of the things that we're seeing there, and finally just the value add of a tax function and what they can bring to a transaction. So with that, I'll pass across to my panel members to introduce themselves to you today. We're hoping it's something that a topic that or topics that you'll see value from as we move through. Over to you, Jeremy.
Hello, everyone. My name is Jeremy Thorpe. I'm a partner in our integrated infrastructure practice in Australia, and I am the Australian Chief Economist.
Hi, I'm Julie Allen. I'm the U.S. National Tax Merger and Acquisition Practice Leader and the U.S. National Tax Services Leader.
Hi, everyone. I'm Irene Tai, Corporate Tax Partner from Singapore. I lead the ESG for our Singapore tax practice.
Hi, my name is Ashutosh Chaturvedi, and I lead the M&A tax practice in India.
Thanks, everyone. Jeremy, we might kick off with you. Very interesting world we have at the moment. We've got, unfortunately, a war in Europe. We've got interest rates rising around the world. We've got inflation. We've got supply chains issues. We've still got countries in COVID lockdowns and the impact on those sorts of things. Where do you see the M&A market? I mean, it's been very, very bullish for the last couple of years around the globe. What are you sort of seeing as the impact of some of these trends and in the markets that we're seeing? Yeah, not just clearly in Australia, but globally.
I do think we have to tell the story of COVID, because I think we're still living in a COVID time, and it's nice to think maybe we're beyond the worst, but nevertheless, really from the period of COVID has really shaped our global economy. And so if you go back to that environment, we shut down our economies in many cases. We imposed barriers to international movement of people, and there was a real concern at that time that we would head into a deep economic shock. That misunderstood the way that we've traditionally rebounded from pandemics. Certainly not at the scale that we may have had this time, but just as we can shut down our economies, we saw that they can start up again relatively quickly in most cases. But it doesn't mean they've started up the same. So what we saw was obviously disruption to global supply chains. And initially, maybe that wasn't as bad as we maybe thought it would be. But what we've seen is a shift away from services in many economies towards goods. And that's because we stopped or limited people's ability to travel on holidays or to move internationally to study or to go to the cinemas or whatever else you might do from a service perspective. And so people have been buying many goods, and we've seen a shift in our economies in the short term, at least, very much towards physical production and physical consumption, even if they may have been sold online and distributed through online channels. Now, that's a significant shift, but it's put incredible pressure on our global supply chains. In addition, obviously, the disruption to people's work environments has, and particularly the imposition of, in many cases, the closure of borders, has meant many companies have struggled where they may have relied on overseas workers, either skilled, semi-skilled or unskilled. And that's just been a significant disruption in many countries, in many sectors. That itself has been a trigger for wage inflation in many countries. Again, not necessarily across every sector in every country, but particularly in those what were previously globally mobile industries. Quite a shock to the system. And so equally, so there's so many interrelated elements here, and I could talk for hours, but equally, obviously, the move to quantitative easing, in most markets, the reduction in interest, in the cash rate, meant money has been incredibly cheap. And again, governments in many cases have sought to manage through a transition of managing COVID by pumping the economy with additional spending. So again, in many countries, households are relatively cashed up. Just an Australian example, our Australian Central Bank ran out of $50 notes last year. I didn't touch a $50 note. I think people are hoarding in some cases. So there is a lot of cash in many households, and cash has been cheap. That has made it meant that both individuals, but equally companies, have been willing to go and buy things. And certainly when you put that with the supply chain disruption, many businesses had to pivot relatively quickly to rethink the way from a physical sales versus online sales, to rethink the volume of goods and services, or volume of goods that are coming through, to rethink about sales maybe more at a local level or direct to home rather than people going to central shopping environments. So that logistics supply chain element also changed domestically, not just from an international perspective. And so that global supply chain elements has really started to bubble up last year. In some countries, again, triggered wages growth, and we started to see inflation. But really that inflationary impact took off really in the beginning of this year from a global perspective in a more broad coverage sense, with geopolitical tensions in parts of Europe. And we saw obviously the price of energy, whether that be gas or oil, skyrocket and become a really embedded feature of many markets. That's often really challenging for central banks to manage, and we've started that cycle of interest rate rises in most countries around the world. If you look historically, central banks have a really bad track record of managing through this type of macroeconomic environment. What we've traditionally seen is central banks overly raise interest rates and actually crush demand, and we see economies go back into a recession. So even though we survived that recessionary, or at least that downturn through COVID, the irony might be the recovery because of that inflationary drive may actually be the thing that is more likely to put us into a recessionary environment going forward. So there are so many moving parts to this, and obviously the risk of ongoing geopolitical tensions in Europe is something that is difficult to say how long that is going to go for. Particularly some of those European countries that have been reliant on Russian energy in the past have a real risk of seeing actual negative growth out of that. If Germany does switch, for example, away from Russian gas, they could see a contraction in their economy of 5%. And so we have that ongoing uncertainty. And when you see higher inflation, what we've traditionally seen is equity markets be challenged. And we've seen that over the last really month or so, where we've seen almost a resetting of the equity markets, the US markets down, I think, about 20%. And what we know consistently is that in periods of higher inflation, returns to equity are lower. And so we will see an adjustment in the market there. So just as cash is going to now be more expensive, it's not going to be as effectively free as it has been for some time, we're going to see opportunities in the equity market be more challenged, but maybe with that resetting of some of those prices actually really provide opportunities as well. From a acquisitions or a merger and acquisitions perspective, a lot of what we've seen over the last couple of years has been driven by that cheap cash, but also businesses being forced to adjust on the fly, whether that buying logistics elements, thinking about or buying software or capability from a technical perspective that they didn't have readily on hand. I've also seen acquisitions which have been staff plays, with labour markets so tight, going and trying to grow through hiring staff is difficult, and the acquisition has been a mechanism for seeing that type of growth. And obviously with health issues number one over the last couple of years, there's been that real opportunity for thinking around that medical space as well. So the pandemic and the nature of the recovery has really provided both the demand for acquisitions and the opportunity for some of those businesses to unlock some of their value.
And I think, Jeremy, to your point around there will be the equity markets are evolving and changing, and generally with the private M&A market, at least, there will be a period of time before prices adjust and expectations are level again. So I think, there is the potential for a slowing of activity somewhat, but I think we've still got a lot of funds, whether they be private equity funds or infrastructure funds or real estate funds, have access to capital, and they've raised a lot of capital. So there'll be still the ability, certainly for significant transaction activity, but it's just a function of whether it will be as bullish as we've had in the last couple of years.
Yes, I think we're going to see a period of disruption, but I think there's going to be demand for acquisitions by companies feeling that real need. And as you said, many have cash. That expectations issue is a real challenge, and I think we're starting to see that even in that startup community, that where businesses have been, in a sense, structured to offer staff options based upon growing share prices. The resetting of share prices is a fundamental challenge to that space. So that will be a real moment where both the individuals and the organisations are going to have to think, what's the true value here?
Yeah, we've certainly seen that in a larger degree in technology than other industries. That's true. Jeremy, very insightful. Thank you very much for that. Julie, just across to you. The M&A, some of those geopolitical and economic issues that Jeremy talked about, how are they impacting on the US market?
Sure. And I'll piggyback off of a couple of things that both you and Jeremy said. One point that Jeremy started with was the impact of COVID. And what we saw in the US is prior to COVID, we saw a little bit of a decline. And then right as we started into COVID, we hit a very busy deal market, right? And what we're seeing now in 2022 is that deal volume isn't as much as we saw in 2021, but it's definitely still very strong. And we were seeing a lot of US based deals, and also the balance between private and public. We were seeing more in that private sector where you were seeing that redistribution of wealth in different areas of the US. So that maybe gives you an overview of what we saw based on COVID. And then I'll come into your question mark on geopolitical events and other events that we're seeing have an impact on deals. As I said, we still have a very, very strong deals market in the US, but some of these geopolitical events, they're definitely taken into account when we're doing deals. But I would put that on balance, Mark, to say that that's always been a consideration for any deal in the US, right? Whether there is a war in a certain area, whether we have controversy, whether there are political agendas or issues that are going on, those are always taken account into a deal. They don't stop the deals, but what we'll see is they will affect certain pieces of the deal or the value of the deal. And it's in that value area that we generally see the impact. And you'll see each side of the deal, the buyer and seller really consider at what point is the deal going to work or not going to work, and at what point do those synergies actually come together, or do those goals and expectations not work because they won't be met? So I would say, where do you see the impact? We haven't seen it completely stop the deals. We've seen it more in the value. A couple of things that I want to piggyback off of what Jeremy said was areas where they were looking at points of the deal that can be affected. And Jeremy, you had noted inflation or the lending. I'm going to add to that uncertain legislation. So with inflation, we definitely see that impacting deals. And where does that impact them? It's really in our deal modeling. And I think, Jeremy, you referred to ROI. And the way I see it is inflation is a key factor in deals, because as that cost increases, the buyer has to determine, are they able to absorb that cost, or is it able to be passed on to the consumer? And that's going to be priced in their deal. And then the second piece that you all were talking about in that lending or that deal financing, that's a second piece that we see being considered in every deal. Because as that money becomes more expensive, then the cost of the deal or the deal financing has to be considered as to whether that's going to work out and whether all of the numbers are going to work out in the end. One other point that I'll put on everybody's radar with respect to lending is with some of these geopolitical events, as we saw banks either seizing their lending or not lending, that will definitely have an impact. And that some of those irrational spreads that we would see, those will factor into deals, and it will be a factor as to whether a deal will continue or whether it won't. So I think the lending is a key piece, but then really watching what banks or lending institutions are doing in reaction to those geopolitical events can have an effect. And the last one that I'll note is really in those factors is that uncertain legislation. As you all know, in the US, we have legislation going on around the world with OECD and other areas. We have different rules with ATAD 3. There's different rules that are changing how that whole worldwide perspective will look on a deal perspective. And so companies are modeling in some of the assumptions to determine how those different scenarios might impact the deal. Those are key areas of focus. Pillar 2 is also a key area of focus right now in the US, where companies are looking to decide just how will they take that into account? How will that affect them? That's a key area. And then I'll throw in a quick twist. I know that Jeremy and Mark, that you both mentioned supply chains, and definitely deglobalizing supply chains or rethinking supply chains or looking at an effective supply chain as a piece that's taken into account in every deal. But one piece that we're seeing on the rise is this throw-in of technology. The companies are really interested in the rise for being tech savvy or having technology support their business. And so I think that that's a twist coming up as US companies invest and they're looking for that technology that's around the world. I think that will have an impact on the deals environment and be one of the key indicators that we see going forward. So Mark, I'll pass it back to you and say that really is, as I look at the geopolitical environment and say, what impact is that having on deals? I think really bringing that down to inflation, to lending, to that uncertain legislation, and then looking at supply chains, all of those are key. And then it really boils down into how do we factor that into the deal value, and does it make sense at the end of the day with the model?
Yeah, no, some very interesting points there, Julie. Just yeah, I think there's a number of points there that not just relevant to the US market, but it's clearly relevant to everywhere, particularly around changes to supply chains and people looking for substitutes, whether that be substitutes um, that they get from another country, or they change um, their their value chain within their organisation to take into account what they need to produce in order to keep their businesses sustainable in periods where the supply chain issues that we are having could well continue. Um, the US, you talked about legislation and uncertain legislation, and the US has generally got some, well, from a non-US tax person, your legislation is very confusing, but um, what are you seeing? US being the largest market, M&A market in the world. What are you seeing? And the OECD are bringing in Pillar One, Pillar Two. What are you seeing around? What are people doing to prepare themselves for the impact of Pillar Two on deals in the US?
Yeah, that's a great question because I would say you're going to see a wide range. Definitely, this is on everybody's radar in the US, and Pillar Two is being discussed. A lot of the reasons it's being discussed is some of the US rules um, that, with respect to our international tax rules, as you look at Pillar Two and think what effect it would have on a certain deal, we're seeing that some of those effects that it's having are not intuitive. So I will break it up, Mark, and say it is all over the perspective. You are seeing some folks try to look at how this would impact a transaction in their modeling. Others are holding on that modeling to see what from we get. But I would say it's at least an attempt to start talking about it and make sure that they're aware of some of the areas. Like I said, there are some international rules like our subpart F and our guilty. When you overlay Pillar Two onto those, the result is not quite so intuitive. So companies who are starting to see that impact are trying to take that into account into every deal they're doing, but still waiting for guidance on it. And I expect that in the next 3 to 6 months, we're going to see more activity in that area and more focus on Pillar Two with respect to deals.
No, I think you're absolutely right there, Julie, and that intuitive tax that some of us that have been around for a long time, it always made sense, but now some of what we're doing in tax world doesn't make sense, somewhat like the accounting world in my mind. But thank you for that. We might just switch tack just a little bit and head across to Irene and just get get an understanding of ESG and where you're seeing that as someone in Asia that's running an ESG practice from a tax perspective, and some of the things that you're seeing that are critical from an ESG perspective in a deal context, Irene. And
Yes.
also feel free to just comment as well what you're seeing in Singapore around just some of the M&A activity.
Sure, sure. So I think if you look at the E, S, and the G, whenever we look at a deal, I think it's important to keep all three elements in mind when you evaluate a deal. And you will often find that, a particular element could be more apparent than others, depending on the target. And I think in the current environment, the E tends to be the more prominent one, given the global focus on it, and especially if the deal is part of a broader sustainable strategy. All that said, I think G is always a good place to start, the governance piece of it. It's important, I think, to first understand if the target focuses on good tax governance, because poor tax governance would be a key cause of concern, as this means that the tax risk of the deal is inherently going to be higher. And moreover, tax governance is increasingly a key focus area for tax authorities around the world. So for example, as part of the Australian Tax Office audit procedures, there's a significant focus on tax governance, including the role of board of directors.
There's no doubt about that, Irene. It is almost, you could say, over the top in terms of the focus on governance versus the actual what is in the tax return is my experience. But no, very true. Thank you.
Yeah, and if we move on to the E, I think a lot of times the key question really to start off with is to ask if the target has an E strategy and has the value been unlocked. Now, if not, does the buyer then have an E strategy to enhance the value of the target? What would it take and what are the potential tax consequences? So for example, does the target have a carbon credit strategy? Has it been structured efficiently? Given that this is a relatively new development in Asia and the legislation may not be all that clear, we'll need to look at whether the direct tax or indirect tax treatment that's been adopted is at risk. I think just now we heard a lot of talk around supply chain restructuring. I think that's very key in the whole ESG space as well. A lot of companies are looking to restructure to enable themselves to perhaps achieve a low carbon or their net zero targets. We need to look at whether the tax impact has been considered as they implement such changes. And if restructuring of the supply chain needs to be carried out post-deal, then what are some of the potential tax optimization options? And in any deal, has green financing been optimized? Did we look at green tax incentives and grants for some of these investments? So, for example, Singapore offers investment allowances for projects that reduces emissions. There are also grants available for investments which improve energy efficiency of industrial facilities. So these are all, good examples where tax can help to improve deal value, and I think these should be factored into the financial model to evaluate the impact. Now, coming to the as the social aspects of it, I think we should also look at some of the tax treatment if there's S-related initiatives. So, for example, investments in infrastructure, investments in the community, job creations, and really evaluate whether there are tax incentives and grants that could be helpful in defraying the cost of such initiatives. Yeah, so I think these are some of the ESG aspects that we should look out for as we consider a deal.
And thanks, Irene. That's quite helpful. I mean, so in an Australian context, yeah, in my mind, there's a few transactions. They might not have been disclosed as ESG type transactions, but I think they have had. Yeah, they have. Their deal flow has evolved as a result of that. Particularly in the public market, we've seen sales. A very large global mining group divested of all its coal assets, for example. And there's another example of a business in Australia that demerged their liquor and gaming business. To basically to have one business that's easy to meet metrics around ESG, and another business that people when they acquire that business or continue to hold those shares in that business, they understand that it might not be on the right side of the ledger from a ESG perspective. Are we seeing in the broader Asia market transactions like that we think have been driven by ESG type impacts?
Yeah, certainly we do see a lot of activity. I think particularly China and India in the renewable clean energy space. We are seeing, for example, in China, state-owned businesses investing significantly more in electric power generation. In India, India conglomerates have been in talk with institutional investors to raise additional capital for the renewable energy businesses. We are also seeing global asset managers with impact funds looking to invest in companies that deliver impact through their products and services, and whilst managing ESG risks. In addition to that, something that's pretty interesting is that we see a lot of companies looking to use Singapore as a hub to invest in projects that generate carbon credits from nature-based solutions, such as tree planting, conservation agriculture in food production, cook stove projects, etc., etc. So it's interesting times. Definitely, I'm going to see more to come.
No, Irene, I think that's very true. We will see a much more significant impact of ESG on deals, and certainly people measuring, you know, impact of certain things, parts of their business, and even understanding more about their business around the social context and those sorts of things as the deal market continues to evolve and grow in the years to come. We might just switch across to you in India, Ashutosh, and yeah, get some. Yeah, you might have some perspectives from an Indian perspective around what you're seeing in the M&A market. But I want to also get you to focus on, things that you're seeing in India around the value add that a tax function can bring to a transaction.
Mark, we have seen a very significant economic activity in India post-COVID. And initially we thought that it is more on account of people wanting to deleverage themselves. But then we realized that there is so much economic opportunities arising post-COVID, which people are wanting to invest in, which people are wanting to take advantage of. And so we have seen frantic activity, nearly frantic activity in the IPO space, a lot of IPOs, some of the largest IPOs coming in either from the startups or from the government sponsored companies. And actually we saw in our history, we saw for the first time quite a significant number of IPOs happening in the startup space. And that was significant, basically, which meant that the investment activity from investors, retail investors in the IPO space picked up. We haven't seen that before. Apart from that, the startup space has really been fresh with a lot of ideas, a lot of funds, and a lot of entrepreneurial activities. We have seen a lot of people migrating from firms like us, from industry, and taking up and setting up their own independent entrepreneurial activities and in startups. And this frenzied economic activity has pushed deals in the technology space to a large extent. We see a lot of investments, a lot of deals in the startup space. That's something which has continued over last 1.5 years. Apart from the IPOs and startups, what we have also seen is that there has been significant deal activity, and I'll say both on account of brownfield as well as greenfield, because of the supplier chain issues being faced around the world. So in India, we see a lot of activity happening where Indian businesses are realizing the opportunity to grab the space to be the supplier to the globe. Maybe health, maybe in the case of agriculture, the business opportunities are amazing, which are arising because of the geopolitical reasons. The other thing which has also happened, and it's kind of a reverse, that what we have realized in India is that we need to be self-reliant at least in few essential areas. And so in areas like healthcare, in areas like pharma, in areas like defense, in areas like essential components like semiconductors, a lot of emphasis and attention being paid and investments being made, and we see this continuing in future. The third thing which I have seen is that we have seen a lot of economic reforms over last 3-4 years. One on account of the GST, the secondly on account of reduction in corporate tax rates. Our corporate tax rates, which were as high as 35-36% a few years back, are now reduced to 25 and to 15% in some cases. That has really increased the amount of revenue collection for the government. Our revenue collections have gone up by 30-40% in last 1 year. Now, this increased revenue provides an opportunity to the government to invest in the infrastructure sector, education sector, and other social sectors. And our sense is this will drive a lot of private investment as well, and lot of deals activity flowing from this. So all in all, lot of economic activity, lot of entrepreneurial activity. I'll say a lot of optimism and lot of what I'll say that uh, innate uh, ability by the businesses to look at opportunities which are there in the country or outside the country. What we have seen is the tax managers and tax consultants have really taken up to the role of advising businesses to consider the impact of tax on the deal, arising from the deal, and factor that in their economic calculations. Well, that's something which we have seen. And what we also see is the tax controllers and tax consultants looking at opportunities to optimize tax outcomes on the post-deal consolidation basis. And that does provide significant opportunity to the business planners to look at the overall cost and profitability post the transactions and the deals. That's something where we are seeing a lot of contribution being made by the tax controllers.
And I'm interested in, and we're only early days, I think, of the equity market evolving and decreasing, and technology has been one of the areas clearly hit in the equity markets. Are you seeing any changes? And you mentioned early in your discussion there just a bit around, you've had a lot of technology IPOs, a lot of people, you know, you know, technology being a big part of the M&A industry or M&A market in the last 6 to 12 months. Has that slowed down at all in the last month or two?
Mark, we have seen a lot of slowdown in the IPO space, but no slowdown in the technology space. A lot of deals continuing to happen, a lot of investments being poured in. So no slowdown in the technology space. Nothing to say in startup sector. That continues as ever. That's something which is pushing the economy forward.
I jump in and just add one point on what we're seeing in India and correlate that to the US? Because I think your point that you made on the IPOs, same thing. We saw a lot of IPOs and those have maybe slowed down, not stopped, but slowed down. And then your piece about technology, I'm just going to come back to that to say that is a big key piece that we're seeing in US deals that folks are really looking at. And then I'll just highlight the ESG one real quick too, is to say we're really seeing ESG get on a rise with questioning and folks looking at how do you bring that from talking about it at a high level to practically monetizing that into the deal and bringing the value there. So just wanted to highlight that all that we had talked about in Singapore and India also correlates into what we're seeing in the US in those areas.
Yeah, I think, Julie, that's a very good point. It's relevant for all of the markets in reality, and some will come in, some will look at those pieces at different points in time as for their own markets. But I definitely think that the things that we've talked about here today, are relevant across across the region, and hopefully, I don't know whether anyone else has anything further to say, but I just wanted to thank you all for your contribution today. Very, very insightful. Jeremy, thank you for you really giving a good summary of the economic factors that are impacting on our M&A markets. Julie, your insights in relation to the US market, very, very helpful, and particularly the uncertain legislation, because that helps our market clearly in terms of advising on uncertainty. It keeps us gainfully employed. Irene, just some of the stuff you've talked about there, ESG, and I think its impact on transactions. It's not going to go away. It's going to become more and more prevalent in every part of an M&A transaction, not just tax, but certainly there is a tax aspect there that we all need to be mindful of. And clearly, our role as tax advisors and internal tax functions of companies is to, when there is a transaction, to maximise value to the company on a go forward, or the combined companies on a go forward perspective. So some of the things you said there, Ashutosh, very, very helpful. And so thank you all for being part of the panel today. I've really enjoyed it, and look forward to speaking to you all soon. Cheers.
Thank you, Mark, and the panel. It's obviously a very turbulent time at the moment after a busy couple of years in deals. And so it will be interesting to see how this plays out over the latter half of 2022, Adriana.
Sure, there are very lot again to come also on this one. So we will now move to our third and final topic for today's session, which is on current and future tax implications on virtual digital assets, cryptocurrency, and metaverse. This session is to be moderated by Peter Bruen from PwC Hong Kong. Peter, over to you, please.
Hi there and welcome to our session on Web3 and the metaverse and what does it mean for taxation. Really excited to have you all here today. I've got a great panel here to speak about it, all of whom have we've been working together quite a while in the cryptocurrency sector and looking at digital assets and increasingly these days on the metaverse as well. I'm Peter Bruen. I'm traditionally a transfer pricing partner, but have been very heavily involved in thinking through how we approach the general taxation of digital assets and crypto in this space as a firm, and also do a lot of work with our cryptocurrency business in PwC Hong Kong. Been in the business since around about 2017 and really, really excited about the sector just because I think it creates so many novel, interesting, fascinating situations we can maybe speak through when it comes to taxation. I will introduce a couple of my other co-panelists here. Rebecca Lee, over to you, please.
Sure thing. I'm Rebecca Lee, and I spend my day job helping companies that are navigating the metaverse and dealing in all manner of digital assets. By background, I'm a complex financial transactions tax partner, and I'm probably a little old and cold in this space. I've been helping clients in the space since 2011. When in San Francisco, some of my clients wanted to do things like pay employees in this fun thing called Bitcoin. And I wish they did, and I wish everyone had held on to it, but instead we're all here.
Rose, over to you.
Hi there, my name is Rose. I'm a financial services tax partner with the Singapore firm. I'm excited to be here today together with my panelists. I've spent the last 5 years dealing with a lot of projects in the digital asset space and excited about talking through some of these issues that we see in the traditional capital markets and how we bridge that into the new world of virtual currencies.
Thank you, Rose. Elgin, over to you.
Thanks very much, Peter. Hi, everyone. I'm Elgin Trombitas, ET for short, from PwC New Zealand. Really delighted to be talking with you today and with the panel, of course. So I'm a GST partner here in New Zealand, but I also lead the Global Indirect Taxes Digital Network. So we've had lots of questions on crypto and NFTs for a long time. I've been involved with the remote services rules here in NZ since 2016 and very happy to contribute to the debate. Thank you.
Great. Thank you very much, Elgin. And then last but not least, Joyce, over to you.
Thanks, Peter. I'm Joyce Tong, corporate and capital markets partner with Kenyon Partners, a Hong Kong law firm which closely collaborates with PwC. I've been working with quite a number of startup developers, listed companies, as well as regulators to look into their legal complexities as they navigate through the metaverse. So very excited to be on the panel today.
Great. Well, thank you very much, everybody. So we're going to start off today by just giving a little bit of an introduction into what is the metaverse, because we appreciate that many of you will have heard things in the press. Some of you may have kids that mess around on big virtual worlds and video games, but maybe you haven't necessarily thought about where the direction of travel is in the metaverse, and also some of the building blocks about how the metaverse is evolving and being built, which may then start to have an impact on what does it mean for taxation, particularly as more companies start to explore the metaverse as something that they want to do business in or want to do business with. So I think from a base point of view, the metaverse really is a virtual world where you have an immersive experience. So it's a little bit like a sort of, you can effectively interact with people, you can speak to people, you have a presence as an avatar, and you can then interact, and we can then explore sort of what that means then from the point of view of, property rights, what happens on the metaverse when it comes to things like actually the ownership of assets within that world and what it brings with sort of blockchain technology. So there's a lot to unpack there. And actually, I think that we did what I think is actually a really helpful piece of thought leadership here that was done out of our guys in PwC US. And they really sort of thought through what are the sort of the 6 big concepts or components that are really starting to make up some of these new metaverse platforms. And I think some of these I'm going to bring up a little bit more detail because I think they are important for how we think about taxation in this new world. And I think I'm going to go through them now one by one quickly. So I think with respect to sort of the metaverse, it's going to be really important that the right governance frameworks are built up together. So the metaverse has aspects which are similar to the digital world, but also because of the fact that it's immersive and it's 3D and you're interacting with people, stuff actually is more similar to the real world as well. And we kind of end up in this hybrid. So the governance of how do things come together, and in particular for us, how do sort of transactions happen, how is tax collected and things like that, I think it's going to be really interesting as to how that develops and how that evolves moving forward. We'll talk about some of those building blocks and how they're coming together in a bit. Equally, identity is crucial here. And I think for many of you that may have kids or may have also sort of been on some of these games, often you interact with these games as an avatar. You have a pseudonym that you use. It may not necessarily be your real name. You don't always have to kind of ID yourself when you go onto many of these platforms. So often you're actually anonymous. And I think that's actually a similar issue to what a lot of the you have with a lot of sort of digital wallets in the cryptocurrency space as well. And I think this is super important because identity is going to be critical when it comes to tax. And that really is the fact that when you've got avatars and so on, tax authorities, when we're talking about transactions on, say, blockchain, have full transparency of transactional data. They can go and they can look and see what transactions are happening on a platform, what happens to transactions happening on blockchain. But often the identity piece is that missing piece of the puzzle. And so that's where I think a lot of the work's going to come in. Again, we'll talk about some of the tax reporting, which is really bringing in that identity requirement. So that missing piece of the puzzle the tax authority is going to have, which I think is actually going to change more than just taxation in this space, and actually could have a number of other implications for digital identity as well. I think the other thing is just experience, right? So a lot of people talk about the metaverse as being a virtual alternative reality, or something you use virtual reality goggles to access. I mean, I don't think we necessarily see it that way solely, because I think we also need to recognize that it may well be that people access this technology through a smartphone or through a regular PC or through some other device. But I think the key point really is that it will give new experiences and new ways to interact with things, and that could create new business models, whether that's new ways for customers to engage with their brands, or just new ways for people to have fun online that can't see each other physically because either travel restrictions, or just because actually people get to hang out with friends from all over the world now in these kind of spaces, and it takes it to the next level. Persistence is all about the fact that we can't all live digitally at the same time all the time, right? So the digital world exists even when you're not in it, and we need to sort of work out how do people pop in, pop out, and what does that mean for those experiences? And as a company, what does it mean for you to have that 24/7 presence there so that people can always drop in at any time? Maybe less on the tax side of that, but I think let's see. But I think the real big one from tax is about economy, because we all know absolutely everything is certain in life. I think death and taxes are the two things that are certain in life, right? As the saying goes. As economies build up in the metaverse, and as the sort of the native currencies of the metaverse involve kind of things like cryptocurrencies, stablecoins, maybe central bank digital currencies, because these are native and enabled transactions within this space, the taxation is going to be absolutely critical, and there's some really interesting tax questions that come up around location, around taxing rights, around what are these transactions, and so on, which I think we'll also unpack a little bit in this space. The final then being interoperability, and I think this really is sort of around the kind of this goal to try to make the metaverse a space where I can move from one platform to another in a way that isn't sort of got a walled garden around it, where I can take my assets from one place to another. Then we have to also work out, what does that mean, right? If I move an asset from one world to another, has a, you know, what have I changed what I've got? Does it still exist in the previous world? Has it moved? I think all these things also need to be explored, and I think we might find there's some crazy wacky tax implications that kind of come out of some of this as well. So anyway, I'm going to take that economy thing a little bit more and just go, well, how have we seen tax rules evolve over time as the internet has really developed? And I think many of you will have heard of this concept of Web3, in particular when it's referred to aspects of the metaverse, but also aspects of kind of blockchain technology. And really, when people talk about Web3, what they're talking about is a steady evolution we've seen in the internet. So Web 1 was all around websites where you got information downloaded to you, you went to a website and it just told you stuff. It was read-only. Web 2 was when the internet started to become social. People were actually creating their own content. People were then, business models were then springing up that were able to monetize that content. And then we saw things that large kind of tech companies that were able to then monetize that data and create new business models out of that. And that's really been the tech story for the last 10 years. Web 3, though, then takes it to the next level. So rather than just having user-generated content, we also then have user-owned content as well. And effectively, Web 3 enables blockchain, or uses blockchain technology to assign property rights to enable people to actually own, control, and monetize their data. And that is going to, again, is absolutely critical. And, we always say, I remember back in kind of doing economics at university, you give people property rights and they will change the way they behave. They will do things differently, and they will create value. And new business models will spring up when you give people property rights. And this is what everyone's really excited about Web3 about. So when it comes to taxation, we kind of put down the bottom here, and I think this is also really interesting. How has the tax system evolved to take into account these developments in the internet? So when we first started off on Web 1, maybe we were kind of like, there was new rules around taxation of e-commerce, whether it was on VAT, whether it was on the taxation of remote servers, and who has taxing rights over those. And then, the last 10 years, all we've been talking about in tax is kind of BEPS, right? And a lot of BEPS has been targeted at the technology companies that have been able to gain huge power by getting these massive network effects and then monetizing those. And it's been a lot about the redistribution of taxing rights from the location of say, intellectual property owners and capital to the location of the customer in the market, where the data is generated, right? We're seeing, like with Pillar 1, massive changes afoot in terms of how to change taxing rights to reflect that. Also, sort of creation of some of these new digital services taxes. But what's really interesting is actually Web3 may kind of disintermediate all of that. And actually, if Web3 does hand back power to monetize data to the individual again, it may have actually achieved that redistribution of taxing rights that Pillar 1 is trying to do through tax rules by actually technology. So, I think what's going to be really interesting is, does Web3 lead to BEPS 3, right, or 3.0? And are we going to have to really see a completely new look at the way the global tax system works to deal with this? Because it has its own unique problems, and we're going to talk about some of those today. But I think I think what we're really seeing around, if you start to move away from a system where you've got large centralized intermediaries that are collecting all the value, to pushing it out to the people and pushing it out to many, many different smaller organizations or individuals, then tax reporting is going to be absolutely critical, because governments need to get that data. They need to get it from somewhere. And I think we're going to see tax reporting be absolutely one of the big developments we see when it comes to the development of Web3 and what does it mean for tax policy. So I'm going to start our panel discussion here, and we're going to talk through 4 areas that we think are really interesting here about developments and what we're seeing going on. So I've already talked too much. I'm going to hand over to my first panel member, Rose Sim, who's going to talk a little bit about that point which I said was absolutely critical about what are we seeing about transaction or transparency reporting and developments as it comes to kind of Web3, cryptocurrencies and digital assets. Rose.
Thanks, Peter. if you think about the current world, what are we seeing? New trends with the metaverse, some of these emerging trends and issues, NFTs. We've seen individuals that have rapidly adopt the use of crypto assets for a range of investments and financial activities. Unlike traditional financial products, these crypto assets can be transferred and held without the intervention of traditional financial intermediaries and without any central administrator, having full visibility on either the transactions carried out or crypto assets holding. I mean, in this context, the crypto assets could therefore be exploited to undermine existing tax transparency initiatives like common reporting standards. We've heard about the earlier conversation that Peter shared about some of these key trends that tax authorities are facing. The OECD have recently introduced the crypto asset reporting framework. The consultation has just closed. So maybe I'll just share a little bit about the 4 building blocks, again, and some of the challenges that we see in the market. The 4 building blocks within the reporting framework, CAF, as we call it, okay. One is the scope of crypto assets that is embedded in there, the intermediaries that are subject to reporting and the information to be reported, types of transactions subject to reporting, and the last one is on due diligence procedures. So I think the consultation has just closed end of April. What we've been seeing in the market and some of the industry feedback is there is a lot of concern over duplicate or over reporting. In the traditional sense, the hierarchy of which the traditional financial transactions are carried out is clear. In the new world of this decentralized, unregulated world, again, you would expect that there are multiple touch points, okay, on the same transaction, which could result in the ideal state of play if you, again, try to kind of let on to the entire transparency framework and enabling different touch points to be monitored and captured, that could result in over-reporting. That brings us back to a second consideration on compliance burden. Again, the information architecture needs to be fine-tuned, operating systems needs to be enhanced, the data collection point. Some of the practical challenges we see is, to give an example, is on valuation. Some of these tokens or digital assets could have nominal value or a value that cannot be easily substantiated. So if you think through, then from tax authorities to the individuals to consumers, would there be conflict in reportable amounts and reconciliation? So a lot of work has to go on behind it. Lastly, is on consumer education and awareness. I think that will pose a big challenge.
Yeah, Rose, I think that one's absolutely critical, right? Because the new proposals around the crypto asset reporting framework from the OECD, we're no longer dealing with large banks and financial institutions. I mean, they are targeting literally like anybody that runs a website, anybody that wants to take cryptocurrency as payment. I mean, it is a very broad range of people that are going to suddenly be caught up in tax reporting. And, I think this, personally, I'm actually really worried about some of the data privacy stuff. I mean, I don't mind giving data to my bank, but I don't really want to give like all my tax data to a video game company or something like that necessarily. I mean, there's not the same regulatory oversight. So I think it's going to be really interesting how they kind of do this evolves. But thank you very much for that. I think this is really, really critical. I'm going to move now on to Rebecca, who's going to talk a little bit about some of the tax issues that really come up when we talk about decentralized economies. We talked about that before. But Rebecca, moving away from tax transparency, how is this stuff different?
I think Rose made a great point, and you all covered it in the context of transparency as a launch point, sort of the idea that we're going to subject all of these folks, anyone who runs a website, anyone who runs a game, they're going to be subject to this degree of sort of tax reporting and information gathering. But the core reason is because they are providing the services, they are doing the activities on a decentralized basis that we used to commonly think of being done in a single location. Let's take finance activities. There's a lot of press coverage around the concept of DeFi, decentralized finance. The idea that you can take activities that were traditionally provided by financial intermediaries, banks, other licensed entities, and now sort of we went through the evolution, if you will, in the fintech space of you could have peers lend to each other, but you had platforms that facilitated that and did some services around that. Now, truly, you can have ecosystems where folks can lend to each other. They can exchange property. You can have clearing houses that have price transparency and create liquidity. And you can do all of this without a separate entity, like a business entity, who is consolidating that information, without a centralized register that tracks that information, because it's all maintained on the decentralized ledger that is the blockchain. And you can do so with a full amount of geographic anonymity in addition to sort of personal privacy data anonymity. And I think that poses some really fundamental challenges for tax authorities globally, because when you think about digital as a starting point, like I will say it's kind of funny, traditional digital, the idea that you could serve customers outside of where you have a physical presence by reaching them via an app or via technology. Now this is truly, you can have an organization that doesn't have tax nexus in terms of physical juridical entities and even office space in any specific jurisdiction, but all of their business activities are rendered via decentralized activities. And that, I think, causes tax authorities to say, when would an entity have nexus with my jurisdiction? The other thing that decentralization does in the removal of intermediaries, it puts a lot of pressure on how we think about traditionally rendered services. If you think about autonomous market makers, where via liquidity pools, there's access to any cryptocurrency asset that I might want to purchase because folks post their assets to be purchased and they get a return on them. And you never go through a centralized exchange. You never go through centralized clearing. And on the flip side, for those who followed the press in the last few weeks, the absence of centralization also in many cases comes with the absence of regulation. And so it brings a degree of economic risk, but it also allows those activities to be very geographically flexible in terms of where they're conducted. And that sort of ambiguity, that base case ambiguity on, is this even a business entity? Is this a partnership under the common laws of a jurisdiction? Is this entity subject to tax? Are really troubling, I think. And I think as tax authorities are trying to write rules that capture these new kinds of economic relationships, I think they're struggling a little bit because the technology moves really quickly. We've lived this in the US, where we wrote information reporting rules describing certain activities. And by the time the ink was dry on the legislation, the types of technology, even within our digital native companies, had continued to evolve. And the legislation looked a little outdated.
Thank you very much for that, Rebecca. That's actually, I think a really good segue into the next question I had on virtual organizations. But I sort of, to me, like I'm going to sort of maybe step in as a transfer pricing specialist, because I think value creation in this new world is super interesting, right? And I think the one of the things I've really noticed in terms of the sort of the Web3 way of running a company, of a Web3 business model is it's very much sort of run with this whole concept of, some of you may have heard the term WAGMI, or which is short for we're all going to make it, right? So it's all about distributing the benefit to the whole community and having everybody benefit. If the business is successful, then all of the customers, all the people using it will benefit from that growth. It's very much like a collective. What that means, though, is that the teams that are actually behind these projects they're not like getting money from massive equity stakes in this necessarily. Often they own the tokens themselves, or they have a big allocation of the tokens. So they don't make their money through charging for stuff, because that's not the ethos. They make their money by being part of this community and having the token, and the token grows in value when it's successful. And I don't know if we really have a way of dealing with that in kind of traditional transfer pricing, and things like that. And that question of taxing rights is like, well, where does that capital gain tax is kind of quite tricky. So I still haven't got my head around it properly, but I think there's a lot of thinking to do. So Rebecca, going on to that bit about virtual organizations though, I mean, how does this sort of, how do you see this working when we've got, companies where people just kind of met on Discord, they all work remotely, they never get together. I mean, what do we do?
This is a new world challenge. And I think that the coming out of the pandemic, or possibly, one of the things we're observing is that the concept of people working and never having met each other, or coming together and forming a business and never having been in the same geographic place, doesn't seem actually that uncommon out of all the topics we've touched on. But the challenge is a lot of times you can have folks who meet and come up with a business idea, design what in many cases is going to be open source code. So when we think about value drivers, it's not the IP because it's open source, there's no protections on it. They can come up with a business, launch a token, and go into your question around footprint. You run into this base case of, if those two folks never formed an entity, never did anything else, which jurisdictions get to tax them? Do I look to where they sit? Do I look to where the token's traded, where it's listed?
And often they're getting paid by a DAO, so it's not even like there's a central, they're kind of saying, oh, I'm going to develop this stuff, and the DAO's going to give me a grant, and that gets voted on by the community. And so, like, who's their boss, right? I mean, it's just a totally different way of operating.
Well, and payroll. I mean, I had a truly hilarious conversation with someone who was speaking to us representing a DAO and looking to engage for a whole bunch of services, which is its own separate challenge. And I'm sure Joyce can weigh in on the legal challenges of engaging with a DAO because they don't have a juridical legal entity. But
DAO being decentralized autonomous organization, I don't know if we define that for those new to it, but yeah.
Completely fair. But as part of it, they said, well, we have a group who we've made grants to do continued development, and we understand the local jurisdiction needs us to set up local payroll. And so how do we go about doing that? And it was like, but you don't have a boss, you don't have an entity, you don't really have payroll in the traditional sense. But when everyone's being compensated with tokens that are being granted or rewarded by the protocol or the ecosystem itself based on the vote of the members, it gets very tricky complying with a whole host of local obligations, in addition to the making sure that if you're in a, if you are a payor or viewed as a payor, that there's maybe information reporting, withholding, taxes remitted. One of the other things that comes up that sounds really basic but isn't, is that there is a gating question for these folks who meet online, who form a joint venture, if you will, that are in the business together, around if we look to where human beings sit. You can have organizations that might have a footprint in, let's say, 100 jurisdictions. If you then expand a little further, when you say we all win, the folks who win are not just maybe the folks who hold voting tokens and vote in the matters of the ecosystem that own the tokens, but you also have, let's say, all the validators and where the validators are located. And so you grow this set of concentric circles where it becomes really hard not just to classify what is that relationship between two people who now are in this token issuing venture, but all of the folks who provide some kind of role in the ecosystem and where they're seated. And my last little nod to this is there are jurisdictions that are providing specific guidance on what to do with remote workers, I'm putting quotes around that. And so you have to sit there and try to marry up when you don't have a boss, when you're in an activity collectively together. You use the word collective. I was on a call earlier where someone referred to it as a cooperative. It has that same vibe of coming together for the joint benefit of everyone. You don't have remote workers, but you certainly have a dispersed footprint. And if the value is from the collective, if everyone's token goes up in value for something bigger than everyone's individual contribution, you always have this who gets the residual, or who has the right to tax the residual.
Sure. So I'm conscious of time. We're going to move on because we talked about that, but we're going to move on to indirect tax as well, because indirect tax in the metaverse is also super interesting. So Elgin, What do people need to know about indirect taxes in this space?
Thanks, Peter. Awesome perspective so far, and you did invite the concept of people popping in and out. I will now pop in and mainly talk about some cryptocurrency themes, NFT themes, and metaverse trends. But I want to open with some opening remarks about VAT, or goods and services tax, as we call it here in New Zealand. And the global trends in the last few years, it's a transaction-based tax. We've had a digital tsunami out there, and we've tried to keep up with some of the changes that are going on with remote services, taxation, or electronically supplied services, ESS. And Rebecca will be grinning, even the US through Wayfair is starting to collect that type of tax and low-value goods. And the central theme actually has been quite simple with all those rules. We look for the customer, and that's the place where you have to pay tax, right? So it's interesting. It's a digital conversation we're having, but we look for the human. We look for the people, and that's the basis of taxation. So that's a key theme to bear in mind. And the thing that's growing is the platform obligations, be it through reporting. So I'm sort of picking up on some of the earlier themes, and also the sharing economy. We can expect quite a lot more change in that area. So VAT, GST, it actually impacts everyone in the chain that we've been talking about, and we fundamentally look for the human, the customer at the end of the value chain. So packaging it down into the three core areas or the key messages on cryptocurrency, in an overall sense and a bit of a generalization, the cryptocurrency VAT rules around the globe have been a bit more consistent than income tax rules and a bit more agile. So for example, in New Zealand, we've just recently passed law which says that cryptocurrency is out of the GST net. We don't care about cryptocurrency from a GST point of view. And that was actually a move designed to remove market distortions and create certainty. So that was a good move. A number of countries initially started with thinking about imposing GST on cryptocurrency and then resiled from that. So by and large, the common theme is that where cryptocurrency is used as a digital currency or for payment, we've heard that before, that is ignored for GST purposes. And then things like mining activities or activities which add value do have GST imposed. That's certainly the domestic position, and then it kind of all depends whether you've got transactions with non-residents. So that's an area that's developing nicely. And then out of that area, if I could move into non-fungible tokens and NFTs, and this one is very much new and very much emerging and exciting. I even talked to my son about NFTs, and he follows all the football stars around the planet, which is fantastic. Gives me a bit of an education, which is good, along with some of my Kiwi partners here. And the thing about NFTs, it's really interesting from a VAT point of view. It's the what is being supplied. And when you cascade through all of the global rules, you get through, well, it's not a good, it's a service, does an exemption apply? Probably not. We've kind of looked at a few exemptions, and then you're into taxation land. And even in New Zealand, what I said to you before about cryptocurrency, I lied for NFTs. We want to tax NFTs. And of course, if it goes cross-border, the key issue is ESS and remote services. And there the challenges are around, Rebecca talked about traditional digital. It might be easy to find the consumer for conventional digital products, but not so easy for NFTs. If marketplaces are involved, they need to be thinking about their obligation. And it's quite common for NFTs to be paid for in crypto. So there's barter there. So that's a fascinating dimension. So look, we've got a few things to work through there. And I would imagine, if I was predicting the future, that more and more country revenue authorities will produce guidance to help us. And then finally, if I could make a comment about the metaverse and some of the trends we're seeing. So if you think of a virtual event, one of the key issues from a VAT point of view is place of supply. And there's an emerging and growing trend, and I think rightly so, to focus on where is the consumer in terms of place of taxation. And that is going to be a significant trend in the metaverse area for virtual events, to the point where Europe has actually announced that they would change their place of supply rules for virtual events, and we expect that will keep growing and growing globally over the next few years. So it's a fascinating area. Not to mention barter. If you pay for a virtual event in crypto, how does that work? There's lots of questions, and I think I'm pleased we're all in it together. It's a very exciting journey, and
we're all going to make it, Elgin.
I think that was the main things I wanted to just bring to this discussion, but it has been very fascinating.
I mean, I think it's actually interesting that the indirect tax is going similar to the direct tax in terms of taxing rights moving to the location of the consumer, the customer, which is kind of actually a big trend in kind of where we're seeing things move. I'm going to move over now to Joyce, because the legal side of this is absolutely fascinating. And there's actually a lot more to talk about and unpack here than there is on tax even, I think. But this is a tax conference, but I think the legal side is also really important. So, so Joyce, maybe could you talk to our guests a little bit about what you're seeing, some of the key legal issues popping up here?
Yeah, thanks, Peter. Well, for the legal perspective, certainly the regulatory environment is evolving, and there are a lot of uncertainties still, because we see that there's actually very little countries and jurisdictions have actually adopted NFTs or metaverse-specific regulations. But of course, other regulators are closely watching this space. In the area of fintech regulatory, the typical point that we need to consider is for the digital assets involved in a metaverse or a certain platform, what will be the key features and functions which will help it to define the usage of these types of tokens? And a lot of times, some of the regulators around the world, they will take a functional approach and ascertaining whether the tokens, it may have the form of potentially securities-alike features, such as in the situations of DAO, as we've discussed a bit earlier, where it is more like functioning as like with voting shares or, some types of governance-related rights. And also there can be issues related to whether it be used in payments and subject to further regulatory scrutiny and analysis. And also, apart from the fintech regulatory issues, another big topic from the legal aspect will be intellectual property protection. Looking from the standpoint of IP owners, of course, they want to ensure that the underlying assets and also the economic rights, such as the royalties and also the transfer of these IP rights, will be properly handled when it is being transformed into a digital asset. In particular, for the big brands with a lot of brand protection issues in mind as they move their business model from the physical world into the metaverse, we've seen some, luxury brands, for example, they are trying to build some digital goods and products to be sold in a metaverse platform even before the physical launch in the stores. So we need to be very careful as to how we're going to protect the trademarks and even underlying patents by additional registrations, as well as how to contractually deal with these rights between the users and the actual owners. Next, we also have a very real issues about cybersecurity, as well as data privacy. As we mentioned that the metaverse, we're trying to improve with the help of technology on the interoperability issues. But at the same time, there can be vulnerabilities involved when the digital assets are being transferred from one metaverse to another, or when there are issues when they are crossing different jurisdictions between the holders of these assets, platform operators, as well as subsequent transferees of these assets. So you can see there's a lot of complexities arising from these different areas of laws will come into play as we have transactions being done across the metaverse. And lastly, we need to be very careful with the contractual terms for which these digital transactions will be subject to. We need to look into the terms of use and also any documentations on these platform operators for NFTs, marketplaces, as well as developers. in order to ensure what will be, the dispute resolution procedures, and when things go wrong, what will be the recourse available to the users, as well as protection to the consumers, as we are going to do more and more NFT transactions with different use cases. So lots of definitely happening in the legal space, and we need to be very careful with the underlying consideration and the risk involved in order to be sure that we are building a safer and a trusted place when have dealings in the metaverse.
Great. Thank you very much, Joyce. And I think that's all we've got time for now. So I'm going to just close off to say, hopefully this session has been really useful for you just to understand, and we really have only scratched the surface on some of these issues. But if your business is starting to explore some of these areas, you really do need to go back to first principles often with taxation. You really need to look at things in an overall basis. And often it's very, very complicated. It's often not a tried and trusted route forward, that lots of the path that many people have trodden on. So I think it is really important to kind of get advice and really sort of think through. But I wanted to thank my panel here, Rose, Rebecca, Joyce, and Elgin. I think it's been a really fascinating discussion, and let's hopefully one of the first of very many in terms of taxation in the metaverse. Thank you.
Thank you, Peter, and the panel. As we see, a lot of information, and all these topics are evolving very, very quickly. So we need to keep an eye on this, as many things are coming on the way.
And it's a fascinating topic to end on. So this does take us to the end of today's event. So all that remains to say, I think, Adriana, is thank you, and thank you to the audience for joining us today. We hope you found it useful and that there's something for you to take away back for yourself and for the businesses that you're working with.